Stop scrolling. Silver just ripped past $34 in a compressed window that has nothing to do with hype and everything to do with fear. This wasn't slow accumulation. This was fast, defensive, and global. Futures jumped while physical premiums stayed firm. That divergence matters. Here's what most people are missing. This isn't a blow-off top. It's not a paper game squeeze. It's capital looking for shelter right now. And while headlines scream about new highs, the real signal is hiding in the machinery underneath. If you hold metals, trade risk, or rely on paper promises, this affects you. I'm not here to predict where silver goes tomorrow. I'm here to show you what insiders watch when markets shift from calm to stress. By the end of this, you'll know the one pattern that separates panic from positioning. Let's break this down. If this adds value, hit subscribe. We're building a group that reads structure, not headlines. Comment "watching the valve," so I know you're tracking the machinery, not the noise. All right, here's what just happened. Silver jumped from the low 30s to mid-30s in days, not months. Futures led the charge. Physical markets followed without collapsing. That's unusual. Normally, when paper prices spike hard, physical premiums compress. Dealers flood inventory, supply loosens. Not this time. Premiums held. In some markets, they widened slightly. Lease rates tightened without public announcements. Dealer inventories thinned quietly. That tells us something most traders will miss. This isn't speculative froth. It's not retail chasing momentum. It's institutional money repositioning before stress spreads. Here's the hidden layer. When fear spikes, capital moves instantly into paper contracts. But physical supply can't flow back out at the same speed. The valve closes. Price jumps first. Availability tightens later. And that's exactly what we're seeing form right now. Most people are asking the wrong question. They want to know how high silver goes. The real question is, what happens when everyone realizes the exit is smaller than the crowd trying to use it? That's what I'm watching. Not predictions, not price targets. Just patterns that repeat when stress builds in, systems people trust too much. Let me show you how this works. Stop scrolling. Silver just ripped past $34 in a compressed window that has nothing to do with hype and everything to do with fear. This wasn't slow accumulation. This was fast, defensive, and global. Futures jumped while physical premiums stayed firm. That divergence matters. Here's what most people are missing. This isn't a blow-off top. It's not a paper game squeeze. It's capital looking for shelter right now. And while headlines scream about new highs, the real signal is hiding in the machinery underneath. If you hold metals, trade risk, or rely on paper promises, this affects you. I'm not here to predict where silver goes tomorrow. I'm here to show you what insiders watch when markets shift from calm to stress. By the end of this, you'll know the one pattern that separates panic from positioning. Let's break this down. This is the one-way valve. Think of it like a fire hydrant. When you crack it open, water floods out under pressure. Instant, powerful. But try to shut it off mid-flow? That takes time. The pressure doesn't reverse immediately. Markets work the same way. When stress hits, capital can flood into futures contracts in minutes. Electronic, frictionless, no delivery required. But physical metal, that moves at the speed of trucks, vaults, and refineries. You can't teleport a 1,000-ounce bar from London to New York because a fund manager got nervous on Tuesday. That's the valve. It flows one direction fast, the other direction slow. And when fear spikes, the valve closes before most people notice. Here's how it plays out. First, institutions sense fragility. Not crashes, not headlines. Just cracks forming in systems they rely on. Maybe it's currency stress. Maybe it's geopolitical tension. Maybe it's debt rollover concerns nobody's talking about yet. They don't wait for confirmation. They move early. They buy futures to lock exposure. They add physical quietly. They reduce reliance on paper promises. This repositioning happens before retail investors even open their apps. Second, price jumps as capital flows in. Headlines follow. Retail notices. FOMO builds. By the time the crowd sees silver at record highs, positioning has already shifted. Third, and this is critical, physical supply doesn't expand to match demand. Refineries can't double output overnight. Dealers can't magic metal into existence. Vaults don't suddenly overflow. So what happens? Premiums harden. Lease rates spike quietly. Spreads between paper quotes and real-world availability widen instead of collapsing. That's not panic liquidation. That's rationing behavior starting to form under the surface. Think about that. When you see a price spike and premiums compress, that's speculation unwinding. Weak hands selling. Normal volatility. But when price spikes and premiums stay firm or widen, that's the valve closing, and that's what we're seeing right now. You'll catch this pattern whenever stress builds faster than supply can respond. It happened in 2020. It happened in 2011. It's happening again. Not because silver is going to the moon, because the physical market can't absorb sudden defensive repositioning without friction. The machinery has limits. Most traders ignore this. They watch price. They track momentum. They follow headlines. They miss the plumbing. Here's the deeper piece most people don't connect. When institutions reposition defensively, they're not chasing upside. They're reducing exposure to fragile systems. They're asking, what happens if counterparty risk becomes real? What if paper promises don't clear? What if trust breaks? They don't need silver to triple. They need it to exist outside the system. That mindset drives different behavior than speculation. Speculators chase gains. They lever up. They time exits. Defensive buyers build positions. They hold through noise. They don't need to sell. And when defensive buying dominates a move, volatility changes. Dips don't shake them out. Headlines don't matter. Price targets are irrelevant. They're not playing the same game as the crowd. That's why this move feels different. It's not fueled by YouTube hype or Reddit threads. It's quiet. It's boring. It's institutional. And that makes it more dangerous to ignore. Because when the valve closes for real, the crowd realizes too late that supply isn't infinite and exits aren't guaranteed. Circle this. The moment stress becomes obvious to everyone is the moment positioning gets expensive. We're watching that transition happen right now. Stop scrolling. Silver just ripped past $34 in a compressed window that has nothing to do with hype and everything to do with fear. This wasn't slow accumulation. This was fast, defensive, and global. Futures jumped while physical premiums stayed firm. That divergence matters. Here's what most people are missing. This isn't a blow-off top. It's not a paper game squeeze. It's capital looking for shelter right now. And while headlines scream about new highs, the real signal is hiding in the machinery underneath. If you hold metals, trade risk, or rely on paper promises, this affects you. I'm not here to predict where silver goes tomorrow. I'm here to show you what insiders watch when markets shift from calm to stress. By the end of this, you'll know the one pattern that separates panic from positioning. Let's break this down. And that connects to something most people completely overlook: dealer behavior. When silver spikes on speculation, dealers advertise shortages. They hype scarcity. They push premiums aggressively. Why? Because they want to move inventory at elevated prices before the spike reverses. But watch what happens when dealers stop advertising shortages. Premiums stay elevated, but the language changes. Limited availability, extended delivery times, allocation adjustments. No panic, no hype, just quiet rationing. That's what we're seeing now. Dealers aren't screaming about shortages. They're managing inventory flow without drawing attention. Why does that matter? Because it tells us this isn't a retail-driven squeeze. It's institutional repositioning, creating steady drain without public spectacle. Think about the incentives. If a dealer knows demand is temporary speculation, they maximize profit by hyping scarcity and moving metal fast. But if they sense sustained defensive buying from institutions, they manage flow carefully. They don't want to run dry and lose preferred clients. They ration. And rationing happens quietly because it's about relationships, not headlines. This is defensive repositioning at the dealer level. It mirrors what's happening upstream with institutions. Everyone's asking the same question at different scales. How much exposure do I want to paper systems right now? And when that question spreads across multiple market layers simultaneously, the valve doesn't just slow, it starts to lock. Here's where this gets interesting. Most viral claims about crashes or shutdowns are backward-looking explanations for forward-looking moves. Something breaks, markets react, then everyone reverse engineers a narrative. Oh, it was obvious, we should have seen it coming. But the people who actually saw it coming weren't watching headlines. They were watching lease rates, inventory flows, and premium behavior. They were tracking the valve, not because they're smarter, because they know what signals precede stress. Let me give you a framework. When markets are calm, lease rates sit flat. Futures trade at normal contango. Physical premiums compress towards spot. That's equilibrium. But when stress builds, the machinery shifts. Lease rates tick up as metal gets harder to borrow. Backwardation appears in near-term contracts as spot tightens. Premiums harden as physical buyers outnumber sellers. These signals don't appear simultaneously. They layer in. First lease rates, then premiums, then futures structure. By the time all three align, positioning is already expensive. The early movers bought weeks ago. The crowd is buying now at elevated prices. The latecomers will chase at the top. That's always the sequence. And right now, we're between early and crowd. Lease rates have tightened, premiums are firm, futures are showing strain but haven't fully dislocated. That's the window. Not a guarantee, not a prediction, just a read on where we sit in the stress cycle. Could reverse tomorrow. Markets surprise constantly. But if stress spreads instead of fading, we'll see these signals align and accelerate. And when they do, the people watching structure will already be positioned. The people watching headlines will still be asking if it's too late to buy. Stop scrolling. Silver just ripped past $34 in a compressed window that has nothing to do with hype and everything to do with fear. This wasn't slow accumulation. This was fast, defensive, and global. Futures jumped while physical premiums stayed firm. That divergence matters. Here's what most people are missing. This isn't a blow-off top. It's not a paper game squeeze. It's capital looking for shelter right now. And while headlines scream about new highs, the real signal is hiding in the machinery underneath. If you hold metals, trade risk, or rely on paper promises, this affects you. I'm not here to predict where silver goes tomorrow. I'm here to show you what insiders watch when markets shift from calm to stress. By the end of this, you'll know the one pattern that separates panic from positioning. Let's break this down. Now, here's what you need to sit with. Everyone's asking how high silver can go. Wrong question. The real question is, what happens when everyone tries to convert paper exposure to physical delivery at the same time? Think about the structure for a second. Futures markets allow massive leverage. You can control huge silver exposure with relatively small capital. That's efficient when the system is calm, when everyone trusts that paper contracts are as good as metal. But what happens when trust wobbles? When institutions start wondering, can my counterparty actually deliver? Will settlement clear if stress spreads? They don't wait to find out. They reduce paper exposure and add physical. Now multiply that behavior across pension funds, family offices, sovereign entities, and defensive traders, all moving simultaneously, all asking for physical settlement or buying outright. The system isn't built for that. Refineries operate at capacity. Vaults have finite space. Logistics can't scale instantly. There's a hard limit to how fast physical metal can move from sellers to buyers. And when demand exceeds that limit, something breaks. Not catastrophically, not Hollywood-style collapse, just rationing, delays, widening spreads, delivery extensions. The valve closes tighter. And the people who positioned early watch everyone else scramble for supply that's already allocated. I'm not saying this will happen. I'm saying this is what stress looks like when it spreads into physical markets. And the signals we're seeing right now, they're early warnings that the valve is starting to close. Not predictions, pattern recognition. So the moment that matters isn't how high the price goes. It's whether the signals we're watching align or fade. If they fade, stress was temporary. Capital flows reverse. The valve opens again. If they align, we're watching the early stages of a supply-demand dislocation that compounds instead of resolving. And that's what I'm tracking this week. Not for entertainment, for positioning. Because the difference between seeing it early and seeing it late is the difference between positioning calmly and chasing frantically. We stay ahead by watching structure, not reacting to headlines. Let me show you what to track. Stop scrolling. Silver just ripped past $34 in a compressed window that has nothing to do with hype and everything to do with fear. This wasn't slow accumulation. This was fast, defensive, and global. Futures jumped while physical premiums stayed firm. That divergence matters. Here's what most people are missing. This isn't a blow-off top. It's not a paper game squeeze. It's capital looking for shelter right now. And while headlines scream about new highs, the real signal is hiding in the machinery underneath. If you hold metals, trade risk, or rely on paper promises, this affects you. I'm not here to predict where silver goes tomorrow. I'm here to show you what insiders watch when markets shift from calm to stress. By the end of this, you'll know the one pattern that separates panic from positioning. Let's break this down. Here's how this could play out. Path 1. Stress fades. If geopolitical tension eases or currency concerns stabilize, defensive buying slows. Capital that rushed into silver repositions elsewhere. You'd see lease rates drift back down, premiums compress towards spot. Futures contango returns to normal. Physical dealers start advertising again. Inventory flows loosen. The valve opens. In that scenario, early buyers hold profitable positions. Late chasers might get caught. Speculators take profits. Nothing breaks, just volatility that resets. Path 2. Stress spreads. If currency fragility deepens or systemic concerns accelerate, defensive buying intensifies. More institutions reduce paper exposure. More capital seeks physical settlement. More buyers than sellers at current prices. You'd see lease rates spike harder. Premiums widen aggressively. Backwardation deepens as spot tightens further. Dealers extend delivery times without fanfare. Inventory drains continue. Spreads between paper and physical harden instead of narrowing. In that scenario, people positioned early benefit from both price appreciation and supply access. People watching from the sidelines face elevated prices and limited availability. The valve locks. Not advice, not predictions. Just the two paths this could follow, based on how stress evolves. Your job is to watch which signals align. Here's what I'm tracking this week. Signal 1. Silver lease rates. Normal looks like flat to slightly positive. Stable day to day, no sudden spikes. Stress looks like sharp upticks. Sustained elevation. Widening between short-term and long-term rates. What it means. When lease rates spike, metal is getting harder to borrow. That signals tightening in the physical market beneath futures pricing. If lease rates stay elevated or climb further, the valve is closing. If they drift back down, stress is easing. Signal 2. Physical premiums at major dealers. Normal looks like tight to spot. Maybe 1-2 over. Competitive pricing, quick delivery. Stress looks like premiums widening to 3-5 plus over spot. Delivery times extending. Language shifting to limited availability. What it means. Premiums reflect real-world supply and just demand. When they harden during a price spike instead of compressing, physical buyers are outpacing sellers. If premiums stay firm or widen, demand isn't speculative, it's structural. If they compress, speculation is unwinding. In Signal 3, the futures backwardation and roll strain. Normal looks like near-term contracts trade below longer-dated contracts, contango. Smooth roll from month to month. Stress looks like near-term contracts trade above longer-dated, backwardation. Widening spreads. Difficulty rolling positions cleanly. What it means? Backwardation signals spot tightness. When it appears and persists, it tells us physical is harder to access than paper suggests. If backwardation deepens or persists, the valve is locking. If it flips back to contango, stress is fading. Signal 4. Warehouse inventory reports. Normal looks like gradual fluctuations. No dramatic one-day moves, stable weekly trends. Stress looks like steady drains week after week. Drawdowns that don't reverse. Declining registered inventory. What it means. Warehouse stocks show whether physical is accumulating or leaving the system. Slow sustained drains matter more than single-day drops. If inventories continue draining without replenishment, it confirms physical is moving from weak hands to strong hands. If they stabilize or rebuild, supply is adequate. Signal 5, gold-silver ratio during volatility. Normal looks like stable around historical ranges, 70-80. Predictable movement. Stress looks like silver outperforming gold sharply, ratio compressing fast. Volatility spiking in silver while gold stays calm. What it means. When silver moves harder than gold during stress, it often signals industrial, monetary dual demand or supply concerns specific to silver. If the ratio continues compressing, silver is absorbing stress differently than gold. If it stabilizes, the move was temporary. When all five signals align and strengthen, you're watching the valve close in real time. When they split or fade, stress is resolving without dislocation. No guarantees. Markets reverse constantly. This could fall apart tomorrow. But this is how you think about it, not predicting every tick, watching for structural alignment, how I'm positioned mentally, tracking these signals daily, not chasing, not panicking, just observing whether stress builds or fades. If signals align, I'm ready. If they don't, I adjust. That's the game. Stop scrolling. Silver just ripped past $34 in a compressed window that has nothing to do with hype and everything to do with fear. This wasn't slow accumulation. This was fast, defensive, and global. Futures jumped while physical premiums stayed firm. That divergence matters. Here's what most people are missing. This isn't a blow-off top. It's not a paper game squeeze. It's capital looking for shelter right now. And while headlines scream about new highs, the real signal is hiding in the machinery underneath. If you hold metals, trade risk, or rely on paper promises, this affects you. I'm not here to predict where silver goes tomorrow. I'm here to show you what insiders watch when markets shift from calm to stress. By the end of this, you'll know the one pattern that separates panic from positioning. Let's break this down. Here's what matters. This wasn't a crash, it was a message. Silver didn't spike because retail traders got excited. It spiked because capital started looking for shelter. The machinery underneath tells us whether that shelter-seeking behavior is temporary or building. And right now, the signal suggests the valve is closing, not opening. Could reverse, could fade, could turn out to be nothing. But if you're tracking lease rates, premiums, futures structure, inventory, and the gold-silver ratio, you're watching what insiders watch. You're not guessing, you're reading. And that puts you in the group that doesn't panic when headlines scream and doesn't chase when FOMO builds. We stay calm, we watch structure, we don't get shaken out by noise. If you can see the valve, you're already ahead. So here's my question for you. Magnet or wall? Does silver absorb stress quietly and hold it? Or does it hit resistance and reflect it back? Drop A for magnet, B for wall in the comments. I want to see how you're reading this. And if you're tracking these signals in your local market, whether you're buying, selling, or just watching, share what you're seeing below. Real-world data from the community matters. It fills gaps that headlines miss. If this framework helped you see the machinery differently, subscribe. We're building a group that reads markets like participants, not spectators. And if you've built wealth-stacking metals consistently over time, share it. Your discipline motivates others who are just starting. Final thought. The people who position well during stress aren't the ones predicting crashes or timing tops. They're the ones watching signals that precede moves, not headlines that follow them. They're reading the valve before it closes, and now you know what to watch. Stay sharp, stay calm, and keep tracking structure. I'll see you in the next one. Stop scrolling. Silver just ripped past $34 in a compressed window that has nothing to do with hype and everything to do with fear. This wasn't slow accumulation. This was fast, defensive, and global. Futures jumped while physical premiums stayed firm. That divergence matters. Here's what most people are missing. This isn't a blow-off top. It's not a paper game squeeze. It's capital looking for shelter right now. And while headlines scream about new highs, the real signal is hiding in the machinery underneath. If you hold metals, trade risk, or rely on paper promises, this affects you. I'm not here to predict where silver goes tomorrow. I'm here to show you what insiders watch when markets shift from calm to stress. By the end of this, you'll know the one pattern that separates panic from positioning. Let's break this down.